So I think we've all, we've seen how Zomato got listed. It was valued at 65,000 crores, and now it is valued at 1 lakh crores. And what is interesting is today that it is more valuable than, Vedanta. It's more valuable than Cipla. It's more valuable than, 50 other Indian companies. And it's the top, amongst the top 50 valued companies in India right now. And yet, it is a loss-making company. The company is supposed to turn profitable according to projections only after a couple of years. And today it is quoting at 15 times its revenues after 2 years. Now, this is very different from the valuation that we are used to, right? And there are a bunch of companies which are also en route to becoming public. So this will actually change the way companies are valued. And of course, happy to take questions as we go along, also in the end. But that really defines what is startups, right? Startup is all about growth, right? And what you see is that, for example, Zomato is supposed to grow at 45% CAGR for the next 4 years. So that sort of growth, very few companies are able to provide. And that is what a startup is. So a startup is equal to growth. And some of them actually dominate the market. These companies have grown humongously and today dominate the market. But you know what? India is a little different. We are still, work in progress. And the nice thing then is that you could have 5 online grocery companies, Big Basket, Grofers, Jio, and so on. And still each of them could be, there's space for more companies, even in online groceries where there are already 5 big players. So that is the value of, Indian startups. And that's the logic of startup investing in India. We still don't have tech leaders like Amazon and Google, but maybe in the next 5 years, we'll start getting those as well. Companies like Ola, companies like Zomato, they've all gone abroad, and eventually many of them will dominate the market. That's what, just today, there's one more addition to the number of unicorns. Of course, these are companies valued more than $1 billion. Today, there's a company called Droom, which just joined the unicorn group. And that is really defines what Indian startups are all about, and will define in the next 5 years.
Sushanto, sorry to disturb you. Can you please put it on full screen mode, your PPT?
Oh, sorry. I'm so sorry. So if you invest in the stock markets, the typical returns that most people get is between 12 to 15%. And when inflation is about, anywhere between 5 to 10% per annum, it's almost suicidal to put your money in fixed deposits. Returns from startups are, of course, different because they have higher risk. Just to give you an example, the Zomato example, InfoEdge made 10,000% return on the Zomato investment. That's there is a little bit of noise. Somebody will need to put his phone on mute. Which means 10,000% return means that even if you invest in 30, 40 companies, just one of them is a Zomato, you're good to go. And you're probably better off putting your money in a fixed deposit or even in the stock market. Apart from that, as they define the future of the stock markets, they also define, the future of technology, which direction technology is going. Today, we have companies in space research. I think 2 weeks ago, we did a program on one of our portfolio companies in space. But it'll give you a compass of where the world is going in terms of technology. Many of us come with domain expertise in some areas, especially for people of my age. This is also a time to give it back to society in some fashion, apart from, of course, making money. So that's the reason why you want to be a startup. But there are risks, right? Statistically, it says that about 98% startups fail. And then, you have to evaluate them and do legal stuff and so on and so forth. And finally, most importantly, is to raise capital and, in situations where they need to be merged with some other companies, is a critical thing that you need to do. And you have to be on the ball all the time, looking at these companies to maximize their return. And that is where, an angel network like Lead Angels comes in, where the community evaluates a company, they ask questions to the entrepreneur, bringing in different experiences and expertise to the table. Then, of course, professional due diligence and documentation. In India, the legal system is weak, and that's why actually you need more documentation than in other parts of the world. And most importantly, post-investment support and monitoring. And that is what really defines Lead Angels. We are the only angel network which also has an advisory division. And this provides the support to our portfolio companies to do, to fundraise, to M&A. We also provide other services to them, some of them from our own members, to support their journey. Because, however stellar the growth may be, it is not without ups and downs. And if you recall, even Zomato, during the, their business was primarily looking at restaurants, getting people to go to restaurants. And that completely stopped post-pandemic. And yet, they were able to change their focus. Even today, they face challenges from the restaurant owners themselves. There's a big battle going on there where restaurant owners have united against Swiggy and Zomato, but that's part of a startup's journey, and you have to be prepared for that. And not to also discount the legal part. Again, we have an arm which helps in legal and accounting diligence, led by a chartered accountant, because, as I said, the legal system in India is weak, and that's why we need to be doubly sure of what we are signing and making sure that we don't have to go to court if there is something which goes wrong. And this is just to give you a glimpse of what all we have to go through to bring those 3 or 4 companies to be invested in maybe 2 or 3 months, right? So that is the process, and the team which does that, it goes through a lot of hard work for each and every step that we take to bring the company to be invested, and thereafter to find funds for them, find their M&A partners, and only then do we get a good return for our investors. Just aside that, if you're looking to be an angel investor, don't look at investing in one company because, as I said, majority of startups fail. You have to look at least 15 to 20 companies over a period of time to have a diversified portfolio. And at Lead Angels, what we try and do is bring in both early stage and late stage companies to the table so that you can do a level of portfolio diversification at your own level. Recently we invested in a category creator company which aggregates home chefs and the other, which is a company which has already been, which was just starting out, and the other one where, they had more than 5 crores of revenues on the table, have been in existence for, couple of years, and have other VCs already invested in the company. So that's the type of diversification that we bring to the table for our angel investors. These are some of the companies where we have invested in. Super Daily, which got acquired by Swiggy. Shop Kirana is one of the now jewels of the Info Edge. Crown, which is also owns Zomato. There are companies like Go Desi, which have grown by almost from 5 lakhs to 1 crore of revenues per month in a matter of 2 years, again invested by other VCs, just to name a few. But I think what really brings to the table a difference is our team. A little background about me: I used to be in equity markets doing equity research, and I found that startups is going to be the next big thing coming up. And actually, in those 20 years, that is what has happened from the year 2000 till date. Venkat is been a venture capitalist for long, and Dhruv was one of the early employees of NIT, and then being a professor. And one of the mistakes I did was to write a book with him, which he is holding here, called Funding Your Startup. Incidentally, it's gone into the 3rd reprint since it got published. But more importantly, the rest of the team, which is a mix of youth and experience. Someone is a chartered accountant, Manish was here, with long experience in financial services. And the younger, a lot of people, of course, very passionate and professionally qualified to take on this job, which is really, startups is about millennials. What the oldies do in the team is to guide them, whereas what the operations are really run by Kunal, Kruti, Fenil, and others. Short presentation. So, happy to have your questions now. And we have some time to do that. We have, almost 15 minutes time available for Q&A, and happy to answer your questions. I think there are some questions already on the screen. Yeah, any questions?
So one question has come to me, I think on a private chat. So this person is asking, a lot of memes are traveling around. A lot of people are trolling the Zomato issue, saying that they have said clearly, or say Paytm, you have the red herring prospectus kind of thing, which says that we are not seeing foreseeable profits. We are not seeing profits in the foreseeable future. So what would you say to the naysayers who are saying that the valuations should be related to profits? Could you put some comments on that? Because that's how startups are valued at. They're valued on growth. Do you think IPOs are starting to follow the same thing, or that's asked by this person who?
Yeah. So I think I'll just go a little back here. Go back to 100 years. Companies were valued on the assets that they owned. They owned land. They owned a mining lease. They owned a great shop on High Street, and they were valued a lot. If you remember, all these retail companies, Sears and all that, they were all valued on the real estate that they owned, right? Then came the next wave of industrialization, where you had, automotive, the auto sector sort of took over. You had Ford, you had, General Motors and so on. And they started getting valued. They were profitable companies, and they started getting valued on their profits. As we move forward, you see companies are being valued on their earnings growth. They're not looking at just their standalone profits or profits at this point of time, but profits which they will have in future. So finally, the ball has moved from looking at the future profitability of companies. And today you will find that even in the stock markets, there are lots of companies with high profits, but with very low price earnings growth. It is primarily a reflection of the likely slowdown in their profits in the future. Automotive sector is a prime example of that. The PE ratios of automobile companies is going down pretty drastically, especially those who've not moved to EV. And that clearly goes to show that people are seeing a tapering off of growth of petrol and diesel cars. And that's getting reflected in their stock market prices. Now we come to the fact that these are companies not profitable. Facebook was not profitable for 7 years. Today, it's one of the top 5 most valuable companies. Twitter, and there are multiple examples of that. So today's losses are not necessarily a reflection of future profitability, right? This is the other way of looking. So losses is only what the company is making to maintain that 30, 40, 50% growth, which other companies cannot accomplish. So I think that is the sort of change that we will see in the stock markets and valuation in the coming years, that companies will get more and more value on future sales growth and future profitability rather than current sales and current profits.
Interesting, thank you. Shailendra is asking, and I think in some ways you've answered it. So is doing the business how startups do, is that going to be the way going forward? I think we are looking at it. Any comments on that?
So hi Shailendra, good to have you on the network and good to connect to you again. So I think it's going to be a mix of both. I think it's not that profit is something that people will forget, because that is the way that is required to run a company. But I think there will be hybrid models that will emerge over a period of time where companies will go for profit for a certain period of time and then for growth, and they will keep on shifting between growth and profits over a period of time along business cycles. So there's no one answer, Shailendra. It's a mix of both. Does that answer your question, Shailendra? You're on mute, Shailendra.
Yeah, I got it. But Sushanto, a lot of startup people making presentations or talking, they talk either about getting sold, acquired, or going for an IPO. So sometimes it feels as if, are they really interested and passionate about the business they have got into, or they just want to make a big ticket sold?
Oh, Shailendra, again, I'll go back a little bit into history that, when India became independent, a lot of it, we were in that license Raj regime. People would just get a license and sit on that license and then sell it. They were not interested in manufacturing, right? And these licenses would get sold to people. I think, and there are different, there are all sorts of people in every industry. So there are obviously some startups, founders who are only interested in the money part and only interested in getting an IPO or getting acquired, and not really concerned, not really passionate about what they're doing. And that is what an angel network, and that is what, the experience of 200 odd people in our network is supposed to do, is to evaluate whether this founder is just there to make money, or is he also, or is she also passionate about what they are doing and about the problem that they're trying to solve. And that will define the success and failure of a startup. So the founder and the team's passion and authenticity is a critical thing that we want to be, look at. And again, at the network, that is apart from the market and apart from the competitive thing, the founder and his team are the focus of our attention.
I'll just add. I'll just add something to this. Basically, what happens is that we say that 90% plus startups fail, but what happens is there are a lot of companies that have been acquired on the way. If you see most of these companies, YouTube, Instagram, WhatsApp, each of these were acquired along the way. Now, would you call that a failure, or would that acquisition, would you call it a success? That is the thing is, there are a lot of people who build great technologies. Even in the .com boom and bust, there were a lot of companies that were acquired at that time, but the patents and the technologies that they created, they are now being used and are in mainstream today.
Right.
Yeah.
Right. Perfect. Yeah.
So questions from some of my investors. Hi, Sushanto, Priya here. How does an investor, an angel investor, identify the correct space? Quite a few sectors which are already crowded. How does he identify the space?
So I think one good thing about India is that whether we take, edtech or fintech or agri-tech, these are still, open spaces that there could be multiple players. I was just taking the example of online groceries, because today I read about a company in J&K, which is able to provide online grocery on 2G. As we all know, there's only 2G in Jammu and Kashmir, but has been able to provide 2G in J&K. So I think wherever you see problems in India, I think that defines the sector to invest in. So that is one part. The other part is that you will, where you see the maximum disruption happening. So I think you also can, if you look back post, during the pandemic and going forward, geography is becoming history. So wherever businesses which are making commute or travel no longer required, convenience, those are the sectors which replace human requirements, AI. Those are the sectors which will do well. Who would have thought 3 years ago that, you could consult, you could do medicine, talk to a doctor without meeting the doctor, right? Especially those of us in India who are used to waiting for hours in front, at the doctor's reception. Now that has changed. Nowadays, most of the people are actually consulting doctors online. So that's again, these are things that we cannot think of today where there are problems, is actually the spaces where there would be, the maximum growth. Right? Does that answer your question? There's another question from Sushanto. So liquidity is a concern for making higher allocation to the startup investing. What is your view? So I think, if I understood your question correctly, that there is, you will have to allocate your assets, right? You have to invest in, may not be in fixed deposit, but some in quality debt, some in equity, and some you have to allocate to the startup sector. And probably over the years, the allocation to the startup sector, or even in the stock markets, to the startups which are there in the internet, the new economy, which is going to be present in the stock markets, is where you will need to allocate. Now, startups which are not listed are obviously illiquid, and exits are difficult to get. So you have to be therefore cognizant of the fact that some of the companies that you invest in, may do very well, but you may not be able to find an exit. But that's where, again, the angel network comes in, where we look for M&A opportunities for our companies. So there's one company which was called Belita, where we had invested. That company got acquired by another company called Enrich, and that company will be on the route for an IPO. It's already got two private equity funds investing in them. So, as Manish rightly said, that M&A is the liquidity option for startups which are not as spectacular as Zomato, and that's the reason why our advisory team keeps on track the companies to see when there is an M&A opportunity. Right.
And just to add one more thing to this, Sushanto, that is exactly the reason. The illiquidity is exactly the reason why we promote that you should not be investing more than 5 to 7 in a year. Your asset allocation should not be more than 5 to 7% of your total portfolio. This includes your portfolio size will also include immovable property, which is not your residential house. So if your portfolio is, let's assume, 10 crores, you should ideally be investing between 50 lakh to 70 lakh in the startup portfolio, not more than that in a given year.
So can I make a suggestion here, Manish and Sushanto? Is it possible that lead angels or similar firms can attempt to create some kind of a secondary market for these investments? So, you obviously have access to these investors who have invested in the previous startups, and then one of them wants to exit because he has some personal emergency, right? And there could be other investors who continue to be bullish on investing.
So, but clear thing, Anil, in this is, see, companies that are doing well, you are better off holding that stock. Okay, like we got exits within Series A, which is pretty rare in Shop Kirana for our investors, and many of them took an exit at 3.5, 4 times. While the people who stayed invested, so the company valuation is more than 50 times right now.
Anil, just to answer your question, yes, we are looking at ways of providing exits to our investors. As you know, that SEBI has certain guidelines, and company law also has certain guidelines where you cannot create a market for unlisted stocks, right? Because you would then, per force, be actually setting up an exchange. But yes, we do find exits, and just now, one of our portfolio companies, Carved Niche, some of the investors exited, some of the investors remained on board. So each time a company goes in for the next round, Shop Kirana as well, some of our investors opted for an exit. So if your company is doing reasonably well, it will have future fundraisers, and in those future fundraisers, there is always an opportunity, or mostly an opportunity for exit. Having said that, watch, you're part of Lead Angels, you will get to know pretty soon. We will actually have a mechanism of selling secondary shares.
Perfect.
I think is Archana there?
Yeah.
Acknowledge the presence. Yeah.
Thanks a lot, Sushanto, and everybody for your questions. Can take
what we'll do is that you can note down all these questions, and we'll try to answer them over at the end of the program, or we will answer them over email. Please leave your email IDs also, but please do stay with us. We have Archana here. Hi, Archana. Thanks for coming.
Hi. I think my video is off. Just give me 1 second.
I somehow can't see you.
Yeah, 1 second.
All right.
Yes, very much. Over to you, Vitansh.
Yeah. Thanks a lot, Sushanto, and everybody for your questions. Moving forward to our discussion on how Zomato is right to its IPO is the coming of age, not just coming of age of not just the new India, but also its young startups. I'd like to invite Dr. Archana Hingorani. She's already here, founding partner of Siana Capital, to take it from here. I'll just give you a brief introduction of her. So Dr. Hingorani has over 25 years of experience in the asset management business. In her formative years, she helped create India's first private markets fund and has invested in over 150 companies across a spectrum of industries, across early stage to mature firms, and has managed assets of over $4 billion. She has a rich experience in fundraising, investing, nurturing investments through 4 different economic cycles, and carving exit paths. She runs Siana Capital, an asset manager focused on nurturing young technology and science-backed companies. She also serves on the University of Pittsburgh's Chancellor's Global Advisory Council and the advisory board of Talentnomics, a Washington-based group focused on encouraging upward movement of women in the workforce. She is also an adjunct faculty at the Katz Graduate School of Business, University of Pittsburgh, for private equity and venture investing. In the recent past, she has been recognized for leadership by Business World, Fortune India, and Asian Investor. She currently serves on the boards of Alembic Pharmaceuticals Limited, Grindrod Norton, Sidbi Venture Capital, Den Networks, 5paisa, among others. We're very happy to have you. Over to you, Sushanto and Archana. Thank you.
Thanks, Hitansh. Thanks, Archana, taking time on a Saturday. Saturday morning, right? It's still morning in Bombay, right? It's the sun comes out a little late. I'm here in Delhi today. So over the next half hour, we'll look at this whole thing about Zomato IPO, and there are people who criticizing the valuation, somebody saying the valuation is very low, and as normal, it's very much in the news, but rarely has an IPO got so much into the news than in the past. So I just wanted to ask you a few questions, Archana, and then we'll open the floor to the audience who's been waiting here to hear from you on your thoughts about this. So, Archana, that's what we learned in school, in our college, that companies are valued by the assets, people are known by the assets that they own. Companies were valued by assets, then by profits, then by future profits. But here is a company that is getting valued at 15 times their revenues after 2 years, right? Their future revenues, that's the valuation of Zomato, right? So how do you, how do we reconcile to this? So what do you think about this? And is this the way of the future, that companies will get valued at, their revenues after 2 years?
So of course, I should put a disclaimer. I'm not a public market specialist any longer. I mean, if you had asked me 25 years ago, perhaps. But yes, you're right that, valuation metrics have changed over the years, right? So it's not new. It's not new that these concepts keep happening. For example, if you go back to the 2000s in India, retail was just beginning, right? So you had the likes of, Shopper Stop, etc., trying to value themselves. And the first time you heard that they wanted 2x of their sales because, their margins were so minuscule. And why were their margins minuscule? It was because it's the same issue that you're seeing today. Do you spend on, in Zomato's case, customer acquisition, new lines of business, whereas in the old retail concept, it was more about, new stores, right? So if they stopped making new stores, their margins would go up, and then that would be their long-term value, right? So they kept insisting that you should not look at our margins or profitability, because although it is profitable, it is minuscule, right? And it does not reflect the kind of investment that we're going to do, and therefore the return that is expected, and therefore the valuations, right? So and Zomato for India, maybe perhaps we are going through a pandemic. We've not had a great IPO story for a long time. So it's created all this attention. And of course, we're not in the old world anymore. Everybody has an opinion that can be blogged and put on different channels, and suddenly, that becomes the topic of discussion. And not to take away from Zomato's credit, they're absolutely fabulous in what they've created. But if you go back to 97, Amazon debuted in 1997 at $18. It took them 14 years to become profitable. And that 14 years, the cumulative profit that they made was the same as they were making in one quarter just a couple of years ago, right? So it's all a function of how much customer acquisition spending you want to do. Is your model in your head as an entrepreneur? Are you thinking about customer acquisition as being like a landowner, that you have as many as possible, you sort of squat on it, and you prepare different aspects of business related to what you're doing, which allow you to make the customer sticky. Therefore, you're happy to spend that money today and hope to generate revenue later. And of course, get into profitability, because once your growth rates at some point, they will stabilize, and you will start seeing that, growth is not as much imperative as profits. Does that mean that, we should give 12, 14, 24, whatever? There are different numbers, different metrics being floated. It depends on what your assumptions are and what you're trying to do. If you believe the valuation guru Ashwath, then you'd say it's $40. If you believe UBS, you'd say there's potential to go to $200. So it's all a function of that. But if you leave all of that, that's noise. To your point, I came in a little early and I heard you say that, then now we're starting to look at future profits. But that's what valuation is all about. The principles have always been the same. Your terminal value was that. You struggled with it every time you decided to value a company, because you had to imagine what that growth rate would look like, right? Now, in this case, it's a little bit more elongated. You have to think a little longer, and you can't just say one value that is going to G is equal to 5 for the rest of the future, and I bring it back and that becomes a value, because there are no profitable benchmarks. So you have to say the next 3-4 years it'll grow fast, no profits, maybe it'll taper a little bit, still no profits, and then maybe in the future. So you have to build business models. But I don't think that principles of valuation have changed. Yes, the excitement probably has changed. The kind of companies that we have changed. I mean, it's unfair to say that, this did not happen before, because there were no services companies. Let's say you go back to, when stock markets began, it was all industry, right? So therefore, you were so used to looking at physical assets, and you felt comfortable that there's an asset, so it will generate some kind of income and therefore return, right? So it's a different way of looking at it.
Sure. Moving on, that's the other thing that people talk about the stock markets these days, that, by the time a company lists on the stock market and there is not much scope for valuation or appreciation, because, every ounce of value is being squeezed prior to the IPO, and the IPO price is built in. And I'm also not from public markets, and you're probably the best person to answer that. But and it's been observed of late also that very few IPOs were able to make that sort of buzz like Zomato did, and it's like almost double its 70% more than its IPO price. Do you think that the incoming startups with their volatile valuations would make stock markets more lively in the future, and therefore potentially give opportunities for investors to, make money?
So I even on that, this is not new, Sushanto. The only period I remember, because we are all sellers in the market, right? If your assets are doing well, IPO is your best form of exit. And if you go to 2000 to 2005 period, all the IPOs that happened during that period, perhaps because markets had not experienced private equity. I'm just talking about private equity, venture kind of companies going public, right? And you had not experienced it ever. So the pricing that you left at the table, and because of the regulations, you also could not sell, right? You locked in for a year, etc., right? So in my head, if you priced it right in this right in the sense that you allowed, because there is an expectation from shareholders who are coming in that there will be some kind of a return over the next coming years. And of course, there's super excitement if it passes and hits some crazy number, and then, it keeps coming back. So I wouldn't put too much stock in the fact that it has doubled, since debut. You have to see what it does over the next couple of years. But leaving that aside, Indian markets, international markets, you take Robinhood, for example, some of them are overpriced and they will bump down, right? Is everybody going to do that? It all depends on what the entrepreneur wants and what his existing shareholders want. If you're fully aligned in the sense that if there's a huge offer for sale, yes, there is misalignment, right? Because the guy who's going away, he's never going to look back on this, right? That's not he's nurtured it for 10 years. He wants to get out. He wants it to be at maximum valuation. The entrepreneur, on the other hand, has to think about balance. Yes, it would be great to have value created, which allows you to show that your company has performed phenomenally. But if you price it incorrectly, it's only you who has to worry about it, because it's one thing to go public and have all this hoo-ha happen, and every quarter coming back to the markets explaining why you're doing what you're doing. It is a life by itself. So you have to balance that, and I think some companies balance it well. Perhaps Zomato has, but it remains to be seen. But as I said, there are different ways of looking at the valuation. I would say that it's right now jumping from 70 to whatever it is today. Yeah, I would think it is overvalued, but it will settle. So, but the fact remains that there are IPOs that will and that won't. And your question will they all create the same kind of buzz? Perhaps, because this is it's a new area, just like in the 2000s. You came in at not a significant, a reasonably good, attractive price, because you wanted markets to accept you as a new phenomenon, that this is not just entrepreneur driven, it is also large PE investor driven, right? In this case, the phenomenon is these are startups. They don't have profits. There is potential, right? So in order for new investors to accept you because you're different and you have certain parameters that don't match traditional thinking, perhaps you do a pricing that is materially not exactly overpriced or fully priced. You do it at something that attracts people.
No, and it takes time. I remember in '94, I was an equity analyst looking at the IT sector. And IT stocks in those days were valued at 4 to 5 times their future earnings. And that was, and that was thought to be pretty decent, because the market was yet to understand the fundamentals of software service business.
Yes.
Those PE numbers are very different. But coming to my last question, because then we'll open it out to the audience, is that with all this happening, what do you see the future of, angel investing by these IPOs? How do you think it's going to change over a period of time? What is your advice to angel investors?
So to me, whether you're an angel or somebody like my firm, which is a pre-series A, what is relevant if you're convinced you want to be an investor, is to focus on the entrepreneur. There is nothing else you need, in my opinion. Does it help that you can see success stories out there which allow investors, angel or otherwise, to say that, yes, this is an asset allocation I'd like to do, because I can now see what it means. If not every company goes IPO, but there is potential. Look at this one. It perhaps encourages people to think about it more seriously. But other than that, I think whatever you need to do in terms of, picking the right entrepreneur, hanging out with him for X amount of time, looking at his highs and lows, how he associates with other people, any other form of due diligence is probably topmost priority. I don't think anything else is relevant at that point in time. It's too early.
Great. Thank you so much. And so I think if I were to sort of conclude, say, it's business as usual for stock markets and investors. Don't get too, dazzled by what's happening to Zomato and what might happen to a few more which will come. As far as, as investors, whether in the stock markets or earlier stage like VCs and angels, focus on the entrepreneur, focus on the fundamentals. Don't worry too much about these great numbers and great IPOs. But yes, it gives you some comfort that slowly the market is going to discover this. And this is one more way of exiting from your investments. Over to you, Gitansh. For anybody has questions, please unmute yourself. And if it's addressed to Archana, please ask her.
Yeah, we would be happy to take any questions that you guys might have. So please feel free to drop your questions
We have
on the
10
chat
minutes
box.
for these questions, so please go ahead.
There's a question by Kush. Kush, could you unmute yourself and ask that?
Yeah, sure. Thank you so much. So my question is to Sushanto ji. So I just wanted to know that as an angel investor, how involved we should be with the founder after the fundraise on giving them a guidance and creating partnerships or mentoring them or making connections with them. This is coming up because I see that you are a director in one of the companies that I am an angel investor in, and that means that you are also an investor and you are also handling certain strategic issues in guiding the founders. So that is one point. Second point is, what are the boundaries that an investor should keep in mind while trying to help the founder? So I want to know from your experience what all things I should keep in mind if I am invested in a company and I want to grow that company by spending my time on it without expecting any monetary benefit out of it.
Right. So it's a difficult question, Kush. I'll try to answer it as briefly as possible. So I think the key part to understand is startups do need support. They have, they need credibility, they need contacts, they need help. They need help in all areas, just like a child, it needs help in all areas. But as the child grows, you don't want to be, acting as the teacher in class and trying to teach him what to do. So it's a soft, you have to become his friend or her friend and help them along the way. Entrepreneurs are very, independent-minded people, and sometimes they don't like too much interference in their work. So it's a fine line between being bossy and being supportive. And so one is to provide professional services. That's what Lead Angels does. That's what all venture funds do. But also mentoring. When the founder needs you, you should be available. And that's what Lead Angels does. And of course, some of our members are also involved in providing that shoulder to cry on for the startup. I hope that answers your question. Archana, would you like to add something?
Thank you so much.
I'll just add one more thing to this. And I think Archana would be also equally adept at answering it, because you are invested into the company. Do you expect any other compensation from the company? Because if the company does well,
that's the compensation.
Yeah, no, well, of course, it depends on how you've thought about it over the years. We don't expect that, because the idea is to be able to take the company to the next stage in whichever manner possible. And that's how we would run the shop. And I think most shops are run like that. And now, of course, now you even have regulation where you can't do that. Yeah. In any case. So recognizing that there can be conflict in that. So, but leaving the regulation aside, I think it makes eminent sense once you are invested to help that company whichever ways possible. Like Sushanto said, some don't particularly want your advice, they only want your money. Sometimes they come back midway and realize they need more than money. Sometimes they come back and make it your problem. Like, they've done exactly what they wanted, but they come back and say, now this is not working. Now you tell me what to do. Otherwise, what should we do, right? So it's like Sushanto said, you have to be their friend. What is a friend? Friend is somebody they come to before a good or a bad news is going to happen, so that it can be corrected, not after everything is done and they're coming back to you, because that's the relationship you have. So from our perspective, we don't ever not sit on the board. And it's challenging nowadays to sit on boards because of different kind of rules and regulations and getting stuck if something happens to the company. But that it cannot be an excuse for not sitting on the board. So we sit on all our boards. and help as much as possible. And obviously, it is not for any consideration beyond the fact that we'd like that return to be attractive and within certain expected timeframes.
Correct. Any other questions?
Yeah. What is a pragmatic time frame that an angel investor should have in mind before investing? And as a continuation of that, how does he ensure that he exits at the right time? Like he chooses to invest, but how does he ensure that he exits at the right time?
So to your last question, when do you exit, etc., from an angel hat perspective, it all depends on, I can wear my hat and tell you as a fund, I'd like to exit anywhere between 3 to 6 years, because that's the amount of time anyways younger companies take to sort of get their bearings, become more than revenue ready, have healthy numbers to show that whoever the next round is can take care of. But from an angel perspective, because you're coming in sort of in the very, very early stages, I would, if I was an angel, I'm not, for obvious reasons. I don't want to be conflicted, so I don't ever invest in something on my own. One would expect that within 3 to 4 years you should be getting it back, right? I would not want to stay longer than that. I know there would be stories like this one is going to sort of kick it off and become, I don't know, the new word is decacorn. So we're not looking for unicorns anymore. But it all depends on what your horizon, your expectations of return are, right? In my head, if I could make that return that I was looking for, whatever that benchmark return is in the time frame, and it's not just about return, it is also about the multiple, because return is just a benchmark to compare to everything else. But your multiple is what allows you to take that money and do whatever you want with it, right? So both are relevant and important. And if you're getting that, then one would want to exit at the time frame that you're hitting that, hopefully and ideally within in a 3 to 4 year time frame.
See, of course, Priya, as a fund has a requirement that it needs to exit so that it can return the capital to its investors. Many funds have that. As an angel investor, you're not constrained by that. You can hold the stock forever. The other way of looking at it is, as long as the company is doing what it's supposed to be doing well, you should hold on to the stock. That's true about a stock market company or a startup. You want to be there while it's doing what it's supposed to do. And when, as Archana said, when it has met its requirement, maybe you can partially exit. And if it continues to do what it's supposed to do, continue to hold some of the stock. Because then, if you had invested in Zomato early on and exited, you may not have got this sort of 10,000% return, which InfoEdge got in the IPO. So I'm saying, as an angel investor, you may want to exit. Partially, you have that luxury. You can partially exit and partially hold on to the stock. Any other questions?
So one clear case is also, if you've noticed, InfoEdge has sold only 375 crore worth of stock they are holding. I think the holding is upward of 15,000 crore. So as Sushanto is saying, if there's steam left in its growth, you should just stick on. And if you're allowed to take partial exits, do that.
Right. Any questions? Please unmute yourself. And we have time for just one more question. Is there something on the question on the chat that
No, not on the chat. If anybody feels like asking any questions, they can please unmute themselves or drop in a message.
Sushant, I have a question.
Go ahead.
This is Titash. I have a question.
Hi.
Yeah. So I think you mentioned about a hybrid model between growth and profit. Maybe in the future that's going to come up. So can you give some idea like how the thing is going to swing? Because it's very hard to imagine how you're going to balance growth and profit at the same time.
So I think Archana was talking about that a little earlier, that companies, public companies have to report their earnings every quarter, and what publics and financial analysts are looking for is that delta, sequential growth and Y-on-Y growth. And even if you are a well-funded startup, you have a board and you will be looking at those questions all the time. An entrepreneur has to balance between growth and profitability all the time, or the lack of losses, if I may use the word for startups. So it's a balance which every entrepreneur has to do. And I think the only change that is happening as we go, that the focus is more and more on growth than was in the past. Because in the past, market shares were largely stable. So if, Ford Motors had X percentage of the market, it would not change significantly over the next couple of years. So it could focus on profitability and not worry about growth. Whereas now, because market shares change so rapidly, that founders have to be very focused on both market share and growth. Archana, what do you say?
So I would say that it's not about just balancing profit and growth. It's what I think. If you look at any of the startup models, not just this one, we're a little behind in terms of our models going to IPO. It's a function of where do we see the growth coming from, and what all are we doing to balance it. So for example, in the case of Zomato, the biggest risk they are running right now, it says 40% them, 40% Swiggy, rest is with the small guys. But we also know that in their particular case, there is a Reliance equivalent of Amazon entering the market today, right? Look at what Reliance did to mobile, cellular companies, right? All the old ones, although both were new age, they were not old age businesses. They're struggling to survive, right? So you have to decide in the short run or medium term whether you want to acquire and make your clients as sticky as possible. So obviously you have to spend money for that, which means that your profits will not be that visible, very, very quickly. I know that in their case, they're saying 25, they should be, EBITDA positive, etc. If that is the case, it's very easy then to figure out profitability. But if it takes longer, it will be different, right? So balancing growth and profitability has always been the case for every company. It's not just for them. In their case, it shows up as cost of acquisition of customer. In older economy businesses, it used to be showing up as new capital being spent, new plant being created, that creates the negative, right? The profits go down. Markets are used to doing either of those. So in my head, it's not very different. It's just new nomenclatures for the same thing. I hope I've made my point clear.
But of course, Archana, the focus on growth is much, because the markets are far more dynamic. Market shares are more dynamic now than they were, 50 years ago or 75 years ago. Companies have to be cognizant of that. So thanks very much. I will not take your time. If there are any questions, we will pass them on to you. Please email your questions or on the chat. Thank you very much, Archana, for being here. And
thank you.
Thanks.
Bye.
Thank you. Any more?
And we will be hosting another program in the next fortnight. Would love to invite you for that one too. So please join us for our knowledge series fortnightly workshop. And in the meantime, anything you want to know on angel investing, feel free to reach out to Gitansh or me, Manish Johri.
And I'm putting my email here as well. If anybody wants to ask me a question, you can ask. Thank you very much, everyone. Have a nice weekend. And any feedback, any suggestions, how we can make these programs better and more useful, we'll be happy to know.
I'll be dropping the link for the feedback. So please send in your feedback so that we can optimize these workshops in the future and make them better for you. Thank you.